The era of cheap money is officially dead, and the last domino of the global economy, the labor market, is finally beginning to wobble.
Former Federal Reserve insider Joseph Wang warns that the neutral rate is much higher than the Fed admits, meaning the high-interest environment you see now is the new normal.
We've distilled over 10 hours of analysis from experts like Basmajian, Nick Gerli, and Jeff Snider into these concise, eye-powered insights to save you time and protect your portfolio.
From a 26% spike in mortgage repossessions to the perfect storm of liquidity drains described by Cem Karsan, we are uncovering the structural rot the mainstream media is ignoring.
Stick around to discover which unloved asset class Rick Rule is moving massive capital into before the rest of the market catches on. The era of cheap money is dead. According to Joseph Wang, the neutral rate, the interest rate that doesn't heat up or cool down the economy, is way higher than the Fed wants to admit.
Exactly. Joseph argues that the structural floor for interest rates has shifted upward, meaning we won't see those 0% days again anytime soon.
Wait, 0%? I thought my high-interest savings account was finally a good thing.
It is for you, but for the broader market, Joseph notes that this shift changes the entire valuation model for stocks and bonds.
Basically, the old playbook is in the trash. Here is the alpha. Joseph Wang believes the biggest risk isn't a recession, but a massive repricing of long-term debt that catches the market off guard.
He's looking at the 10-year yield specifically. While everyone is watching the Fed's next meeting, the real action is in the bond market's term premium.
Term premium? Speak English, please. Are my bonds going to lose value or what?
In short, yes. Joseph thinks long-term rates need to go higher to attract buyers, which keeps downward pressure on bond prices.
Stay tuned, because while bonds look shaky, Joseph has a second insight on why fiscal spending is actually the new driver of inflation. Joseph Wang's central thesis is that we've moved into a period of fiscal dominance. The Fed can hike all they want, but the government is still printing and spending.
Right. Joseph points out that when the Treasury is injecting trillions into the economy, the Fed's interest rate hikes are like trying to stop a flood with a garden hose.
So, the Fed is hiking to slow things down, but the government is spending to speed things up. Isn't that just cancel culture for money?
In a way, Joseph argues this is why the economy hasn't crashed yet, despite the highest rates in decades.
It's a tug of war, and currently the spenders are winning.
Joseph Wang is sounding the alarm on the term premium. For years it was near zero, but now it's roaring back.
He explains that investors are finally realizing that holding debt for 10 or 30 years is risky when inflation is unpredictable.
So wait, they want more interest just to hold the same bonds they used to love?
Exactly. Higher risk requires a higher reward. Joseph notes this pushes up mortgage rates and corporate borrowing costs across the board.
And that means the everything bubble is officially popping. Joseph Wang believes the Fed's 2% inflation target is a pipe dream in this new environment.
His data suggests that between deglobalization and higher labor costs, 3% is the new floor for inflation.
3% doesn't sound that much worse than 2. Is it really a big deal?
Over a decade, that extra 1% eats a massive chunk of your purchasing power. Joseph says the market hasn't fully priced the sticky reality in.
It's the difference between a soft landing and a slow burn. Joseph Wang highlights that the Fed is terrified of the 1970s mistake, cutting rates too early and letting inflation spiral again.
He notes they'd rather break the economy than let inflation stay high. That's why he's skeptical of the pivot narrative.
So they're okay with a recession if it means prices stop going up?
In their eyes, a recession is a temporary headache, but hyperinflation is a terminal illness. Joseph thinks they'll stay hawkish longer than anyone expects.
Which means the stock market's hope for rate cuts might be misplaced. Looking forward, Joseph Wang predicts the 10-year Treasury yield will establish a new home above 4.5%.
If that happens, mortgage rates stay high and the housing market remains frozen.
Wait, 4.5%? Wasn't it like 1% a few years ago?
It was, but Joseph says the low-rate anomaly is over. Welcome to the new normal.
It's a brutal adjustment for anyone who bought property in 2021.
Joseph also predicts a rocky road for the S&P 500 as it grapples with these higher rates.
When the risk-free rate is higher, investors aren't willing to pay as much for risky tech stocks. Valuations have to come down.
So my index fund is basically in a waiting room for a haircut.
Basically, Joseph suggests that the buy-the-dip strategy might not work as well as it used to.
Volatility is the name of the game for the next 18 months. Joseph Wang's biggest piece of advice? Watch the 10-year Treasury yield like a hawk.
If it breaks above 5%, everything from tech stocks to gold will feel the heat.
Okay, so keep an eye on the 10-year. Anything else?
Watch the Treasury's quarterly refunding announcements. That's where the real supply shocks happen. Joseph also suggests that in this environment, cash is no longer trash.
Yields on money market funds are the highest they've been in a generation. It's a safe place to wait out the storm.
So I can actually make money just by letting my cash sit there? I like the sound of that.
It's a rare window of opportunity. Just don't get too comfortable. The market moves fast.
Thanks to Joseph Wang's analysis, we have a clear map of the road ahead. Stay vigilant. Nick Gerli from Reventure Consulting is sounding the alarm. The mortgage bubble has officially popped, and the data is pretty grim.
He's citing a Wall Street Journal report showing a 26% spike in mortgage repossessions. That is not a small number.
Wait, 26%? Are we talking about people actually losing their homes right now?
Exactly. These are repossessions, meaning the bank is taking the keys back because the owners can't keep up.
And while this repo wave is crashing, Nick notes there is an even bigger disaster brewing in the FHA loan sector that could make this look like a warm-up. Nick Gerli's core thesis is that the era of free money is over, and the 26% repo spike is the first crack in the dam.
He argues that during the pandemic, everyone was on a housing sugar high, but now that interest rates have tripled, the reality check is hitting hard.
So the sugar high was just low interest rates making us feel richer than we were?
Precisely. Now, as Nick points out, those same homeowners are facing a massive affordability gap.
When you combine high prices with 8% mortgage rates, the math simply stops working for a huge chunk of the population.
Nick highlights FHA loans as the canary in the coal mine. These are usually for buyers with lower credit or smaller down payments.
Hold on. Why are those specifically the problem? Isn't that just a standard loan?
It is, but Nick explains that these buyers have zero equity cushion. If home prices drop even 5%, they're underwater immediately.
And the delinquency rates there are skyrocketing back toward 2008 levels. It's a systemic risk.
So if they can't sell and they can't pay, the bank just takes it. Great.
Another huge factor Nick discusses is the big institutional landlords. They're starting to sell off their rental portfolios.
When Wall Street starts dumping houses, it puts massive downward pressure on prices for everyone else.
Wait. So the guys who bought up all the houses in 2021 are now the ones running for the exits?
Exactly. They see the writing on the wall. If rental yields don't cover the financing costs, they're out.
It's a classic case of the smart money leaving the room while the average Joe is left holding the bag. Nick's data shows that the Sunbelt boom towns like Austin and Phoenix are hitting a wall.
Inventory in those areas is climbing fast. When supply goes up and demand is crushed by high rates, prices have only one way to go.
I thought everyone was moving to those cities, though. Why is the inventory growing?
They were, but as Nick notes, the prices got so detached from local wages that nobody can afford to move there anymore.
It's a ghost town of overpriced listings and for sale signs that have been sitting for months. Nick predicts that we haven't seen the peak yet. He expects foreclosures to hit a 10-year high by the middle of 2025.
It's a lagging indicator. It takes time for the missed payments to turn into actual bank seizures.
So what you're saying is the 26% spike is just the beginning of the storm.
Correct. Nick believes the full weight of these high interest rates won't be felt until next year.
In terms of prices, Nick is forecasting a 15 to 20% drop in markets that were heavily inflated by the tech boom.
20%? My house is my biggest asset. That's a huge chunk of wealth just vanishing.
It is. But Nick's point is that the wealth was paper wealth, created by an artificial bubble in the first place.
He expects the correction to bring prices back in line with what local people actually earn.
Nick's advice? Keep a close eye on the Case-Shiller Index. It's the gold standard for tracking real price movement.
If you see a consistent downward trend there, it's a sign that the wait-and-see period for buyers is over.
So if the index drops, I should probably hold off on buying that dream home for a bit.
According to Nick Gerli, patience is going to be very profitable for buyers in the next 24 months.
You also need to track FHA delinquency rates. That's the lead indicator for where the next wave of distressed sales will hit.
Basically, watch the people who are struggling first to see where the market is going next.
Exactly. Nick's data-driven approach shows that the repo spike is a signal you can't ignore if you care about your net worth.
Buckle up, because the housing market is finally returning to reality.
We are looking at Jeff Snider's latest breakdown of the European economy, and the big takeaway is that the recession isn't just coming, it's officially here.
Right. Jeff points out that Eurozone GDP grew a measly 0.1% in the third quarter. That is essentially a rounding error from zero.
Hold on. 0.1%. Isn't that technically still growth? Like, isn't a recession supposed to be negative?
In theory, yes. But Jeff Snider argues that when you look at the underlying data, the zero is just a mask for a much deeper rot.
Exactly. While the headline looks flat, the industrial core is actually cratering.
And here is the kicker. Jeff believes what is happening in Europe right now is the canary in the coal mine for the United States.
Wait, so we're next? I thought the US economy was supposed to be the strong one.
Jeff would say that strength is an illusion. He's tracking a massive risk for US markets that we will break down in just a few minutes.
It's all connected through global liquidity. If Europe stops buying, the rest of the world stops spinning.
Great, so Europe sneezes, and we all get the economic flu.
The core of Jeff Snider's thesis is the collapse of manufacturing. He notes that the PMI is stuck below 45.
For context, anything below 50 is a contraction. 45 is basically the basement.
Wait, what's a PMI? Like a report card for factories?
Precisely. It's the Purchasing Manager's Index. If it's this low, factories are getting fewer orders and cutting back production.
And according to Jeff, this isn't a temporary dip, it's a sustained downward trend.
So if the report card says 45, the factory is basically failing the class.
Jeff Snider highlights Germany as the biggest concern. Industrial production there is down 2% compared to last year.
That's huge because Germany is the economic engine of all of Europe. If their engines fail, the whole plane goes down.
2% doesn't sound like a lot. Is that really emergency level?
In a heavy industrial economy like Germany's, 2% is massive. It means thousands of lost jobs and billions in lost revenue.
Jeff argues that Germany is essentially deindustrializing because of high energy costs and falling global demand.
So the engine isn't just stalling, it's being taken apart for scrap metal.
Jeff also discusses the inventory cycle. During the pandemic, everyone hoarded goods. Now they're desperate to get rid of them.
Right, Jeff calls this destocking. Companies have too much stuff and aren't ordering anything new.
Wait, so is that why everything is on sale lately, like buy one get one deals?
Exactly. But for the economy, that's a nightmare. If retailers aren't ordering, factories stop running.
It's the exact opposite of what we saw in 2021. We've gone from shortage to glut.
So too much stuff is actually bad. Man, the economy is confusing.
Jeff Snider's favorite indicator, the yield curve, is screaming danger in Europe.
It's been inverted for a long time, which Jeff says is the market's way of saying it expects zero growth and lower rates in the future.
Okay, inverted yield curve sounds like something I should be scared of, but I don't know why.
Basically, it means investors think the future is so bleak, they'd rather take lower interest for long-term loans than risk the short term.
It's the ultimate recession warning, and according to Jeff, it's rarely wrong.
So the market is basically betting on things getting worse. Awesome.
So what's next? Jeff Snider predicts that fourth quarter GDP for the Eurozone will likely be officially negative.
If that happens, it's the formal definition of a recession. 2 straight quarters of no growth or contraction.
Does it really matter if it's negative 0.1 or positive 0.1? It's still basically nothing.
It matters for the central banks. Once it's official, they have to stop pretending everything is fine.
Jeff thinks we'll see a hard pivot in policy once those numbers hit the screen. Jeff also predicts that this European slump will drag down global demand, eventually forcing the Fed to cut rates in the US.
The market is already pricing this in. Despite what the Fed says, Jeff notes the data is pulling the strings.
Wait, so lower interest rates? Isn't that supposed to be good for my mortgage?
In the long run, maybe. But the reason they'd cut is because the economy is broken. It's a trade-off.
As Jeff says, the Fed doesn't cut because things are good. They cut because they're terrified.
Great. I love being terrified for a slightly cheaper loan.
To stay ahead, Jeff Snider suggests keeping an eye on German 10-year bond yields.
If those yields keep falling, it means the market is getting more certain that Europe's recession is deepening.
Okay, adding German buns to my watch list. Sounds like a brand of sausage, but I'll track it.
Close enough. It's the benchmark for all of Europe. If it moves, the world moves.
Jeff also highlights the US dollar. A stronger dollar often means more pain for global trade.
Right? If the euro keeps weakening against the dollar, it's a sign that capital is fleeing Europe's sinking ship.
So if I go to Paris and the croissants are cheaper, that's actually a bad sign for the global economy.
According to Jeff Snider's analysis, exactly. Enjoy the cheap croissant, but watch your portfolio.
It's all about that liquidity, and right now the taps are running dry.
Today we are diving into a heavy-hitting discussion between Adam Taggart and Cem Karsan about why the market seems to be ignoring gravity.
Cem is the founder of Volatility, and his big alpha here is that 90% of market movement right now is driven by flows and liquidity, not the actual economy.
Wait, 90%? So the news about earnings and GDP is just background noise while the math nerds move the needles?
Basically. Cem argues that structural positioning is the real driver, and while things look bullish now, a perfect storm of liquidity drains is coming.
And while this liquidity keeps us afloat for now, Cem teases a massive volatility spike later this year that most investors are totally blind to. Adam Taggart points out that despite high interest rates, the economy isn't crashing. Cem's explanation? It is the $1.7 trillion fiscal deficit.
Exactly. The government is pumping so much cash into the system that it's essentially canceling out the Fed's tightening.
So it is like trying to empty a pool with a bucket while someone else is filling it with a fire hose.
That is exactly Cem's point. You can't have a true recession when the government is spending like a drunken sailor.
And that fire hose of cash is keeping asset prices artificially high, at least for the moment.
Cem Karsan explains that the explosion of 0 days to expiration options is actually keeping the VIX artificially low.
Hold on. 0-day options. You mean people are betting on what happens in just 24 hours?
Yes, and because everyone is selling these short-term options, dealers have to hedge by buying the dip, which prevents the market from falling.
So the more people gamble on short-term drops, the more the market actually stays stable. That feels backwards.
It is a feedback loop. But Cem warns that when this loop breaks, the move down will be violent because no one is hedged for a long-term crash.
Cem mentions that passive investing has become so dominant that price discovery is basically dead.
Right? If everyone's 401k just automatically buys the S&P 500 every 2 weeks, the price goes up regardless of value.
So the stock market is just a giant automatic subscription service now.
Pretty much. As long as people are employed and contributing, the market has this forced bid.
But Cem warns Adam that if unemployment ticks up, that automatic buying turns into automatic selling very fast. Cem and Adam also discussed why inflation isn't going back to 2% anytime soon.
He argues that the era of cheap labor from China and cheap energy from Russia is over. We are in a structural higher for longer regime.
So my groceries are never going back to 2019 prices, are they?
Not according to Cem. He sees a decade of volatility where inflation spikes and then settles at much higher floors than we are used to.
It's a complete regime shift that most portfolio managers haven't lived through.
What's the timeline for this perfect storm? Cem Karsan keeps mentioning.
He expects a melt-up through the first half of the year as liquidity remains high, but warns of a massive window of weakness around October.
October? Just in time for the election. That sounds like a disaster movie waiting to happen.
Exactly. Cem notes that the uncertainty of the election, combined with a seasonal liquidity drain, creates the perfect setup for a crash.
He's predicting a volatility spike that could send the VIX well above 30. Cem doesn't see the Fed cutting rates back to zero. He thinks the new normal for the 10-year yield is between 4 and 5%.
Wait, so mortgage rates are staying high too? My dream of a cheap house is officially dead?
For the foreseeable future, yeah. Cem's analysis suggests that the era of free money is gone.
He believes the Fed will be forced to keep rates elevated to combat that structural inflation we talked about.
Great. High prices and high interest rates. What a combo.
So, what's the takeaway from the Karsan and Taggart talk?
Cem says to watch the 10-year Treasury yield. If it breaks above 5%, the liquidity dam starts to crack.
So if I see that number on the news, I should probably check my portfolio.
Definitely. It's the ultimate warning sign for risk assets.
Cem also recommends looking convexity, basically bets that pay off big when the market moves unexpectedly.
Convexity? Can we say that in English, please?
It means don't just buy and hold. Have some insurance in place for when that perfect storm finally hits.
Essentially, don't be the person holding the bag when the fire hose of liquidity finally gets turned off. Rick Rule just dropped his playbook for the next 90 days, and the main takeaway is clear. He is moving massive amounts of capital back into the resource sector.
Exactly. Rick tells Charlotte McLeod that he's looking for high-yield opportunities in energy, specifically targeting 7 to 10% distributions.
Wait, 7 to 10%? That's way better than what my bank is giving me for just sitting there.
It is, but Rick isn't just throwing darts. He's looking at specific gaps in the market that most people are ignoring while they chase AI stocks.
The real alpha here is his focus on unloved assets. Rick Rule believes the biggest gains over the next quarter won't come from tech, but from physical stuff we actually use.
So like oil, gold, and stuff, you can actually drop on your foot?
Pretty much. But hold that thought, because wait until we get to his controversial take on uranium. That's where things get really interesting.
Rule's strategy is all about being a contrarian, and his 90-day window is looking very specific.
Rick Rule's core thesis is that resources are historically cheap compared to the S&P 500.
He points out that we've seen a decade of underinvestment in mining and drilling, which creates a massive supply-demand imbalance.
So we haven't been digging enough stuff out of the ground, and now we're going to pay for it.
That's the gist. Rick thinks this underinvestment is a coiled spring for prices.
And Charlotte McLeod noted that even with higher interest rates, these commodity producers are still printing cash.
I guess, if you're the only one with the oil, you get to set the price, right?
Rick is heavily focused on oil and gas right now, specifically looking for those 7 to 10% dividends.
He told Charlotte that these companies are effectively cannibalizing themselves by buying back shares and paying out massive amounts of cash to shareholders.
Cannibalizing? That sounds aggressive. Is that a good thing for us?
In this case, yes. It means the cash is going to the investors rather than being wasted on risky new projects.
It's a show-me-the-money strategy for the next 90 days.
Okay, I can get behind getting paid to wait.
Rick Rule always goes back to gold as the ultimate insurance policy.
He recommends at least a 5% allocation to physical gold, especially with global debt levels where they are.
5%. Why not more if things are so shaky?
Rick views it as a stabilizer, not necessarily a get-rich-quick asset. It's about protecting what you have.
He mentioned to Charlotte that gold performs best when people lose faith in the purchasing power of the dollar.
So it's basically a bet against the paper in my wallet. Got it.
We can't talk Rick Rule without mentioning uranium. Even after the recent run-up, he's still bullish.
He argues that the world simply cannot meet carbon goals without nuclear power, and the supply of uranium is still incredibly tight.
But hasn't the price already spiked? Am I too late to the party?
Rick thinks we're in the middle innings, not the end. He's looking at a multi-year cycle here.
He's watching the $100 price point closely as a psychological level for the market.
$100? That's a big round number. I'll keep an eye on that.
Rick predicts a major shakeout in the junior mining sector over the next few months.
He tells Charlotte that probably 80% of these companies are worthless and will run out of cash soon.
Wait, 80%? So most of the small mining stocks out there are just garbage?
According to Rick, yes. They're basically lifestyle companies for the management, not actual businesses.
So the lesson is, be extremely picky. Only follow the best management teams.
Note to self, don't just buy anything with mining in the name.
Rick also sees a path for gold to hit significant new highs as the Fed's narrative changes.
He believes that once the market realizes inflation isn't going back to 2% easily, the real interest rates will drive gold much higher.
So if the Fed can't stick the landing, gold takes off.
Exactly. Rick is betting that the economic reality will force more people into safe haven assets.
It's all about the math of debt and deficits, in his view.
The math doesn't look great lately, so I guess gold looks better.
Rick Rule's biggest advice? Stop gambling on long shots and stick to the best-in-class producers.
He suggests looking at companies with strong balance sheets that can survive even if commodity prices stay flat for a while.
So basically, buy the big guys who already know what they're doing.
Precisely. Let them do the hard work, and you just collect the dividends.
Finally, Rick suggests building a watch list of energy stocks specifically hitting that 7% yield mark.
Keep an eye on the cash flow. If a company is making money and paying it out, that's Rick's green light.
7%, dividends and real assets. I think I've got my homework for the weekend.
That's the plan. Rick Rule is playing the long game while everyone else is trading the headlines. Eric Basmajian from EPB Research is sounding a massive alarm. Employment isn't the first sign of a recession. It's actually the very last domino to fall.
Exactly. Everyone's looking at the steady job market and saying we're fine, but Eric's data shows the first three dominoes, housing, new orders, and profits, have already tipped.
Wait, so the jobs report is like the smoke, but the fire already started in the kitchen 10 minutes ago?
Perfect analogy. By the time layoffs hit the headlines, the recession is usually already halfway over. Employment is the last piece of the puzzle.
According to Eric Basmajian, there's a strict four-stage sequence every economic downturn follows, starting with housing.
Right? Housing hits the floor first because of interest rates. Then manufacturing new orders dry up, followed by a squeeze on corporate profits.
And the fourth one is where we all lose our jobs.
Sadly, yes. Employment is the grand finale. Eric points out that people wait for the job market to break to admit there's a problem, but by then, it's too late.
Eric's analysis highlights that manufacturing new orders have been in the red for over 15 months straight.
That's a huge data point. When companies stop ordering new goods, the factory floor slows down, which eventually hits the bottom line.
15 months? That feels like a long time to be contracting without people noticing.
It is, but it's hidden because services and consumption have been propping up the soft data while the hard manufacturing data rots.
Before the pink slips go out, Eric Basmajian says companies try to protect margins by cutting hours.
Exactly. We're seeing average weekly hours dip to 34.3. That's the hidden unemployment.
Hold on. So my boss cutting me from 40 hours to 35 is actually a recession signal?
It's the first step. Companies would rather reduce your shift than pay for a full layoff package until they absolutely have to.
Why is the job market so stubborn? Eric explains that labor is the most expensive thing to replace, so firms hoard it.
Right? You don't fire your trained staff. The second business slows down. You wait until you're literally bleeding cash.
So the strong jobs report everyone is talking about is actually just companies being afraid to fire people yet?
Essentially. It creates a false sense of security, while the rest of the economy is already buckling under high rates.
Eric Basmajian predicts that once the labor hoarding phase breaks, we'll see a rapid spike in unemployment.
It's a non-linear move. It stays flat for a long time, and then it goes vertical once the first major sector starts cutting.
So it's like a dam breaking, one crack, and then the whole thing goes.
Exactly. Eric's model suggests that point is approaching faster than the market expects.
When we finally get the recession headline, Eric notes it will likely be dated back several months.
History shows the NBER doesn't call a recession until the job data is deep in the red.
Wait, So we could be in a recession right now and just not know it officially for another year.
It's happened in almost every cycle. The data is always rearview mirror.
Eric Basmajian suggests keeping your eyes on average weekly hours rather than just the headline payroll numbers.
And watch the JOLTS job openings. If those collapse, the labor hoarding is officially over.
So if the help wanted signs disappear, that's my cue to start saving extra cash.
That's the smartest move you can make. The last domino is wobbly.
To kick things off, Eric Basmajian insists on a 4-domino sequence that dictates the economic unfolding.
Exactly. He argues that each domino represents a different aspect of the economy, affecting growth in a predictable manner.
So if one domino wobbles, we're looking at a whole chain reaction.
Very much so, it's all interconnected. Next up, Rick Rule believes we are in a resource renaissance phase.
Correct. Rick emphasizes that the shift towards resource scarcity, especially metals, will redefine investment landscapes.
So it's all about precious metals and resources now.
Yes, he sees this as a major opportunity before the mainstream catches on. Cem Karsan contends that fiscal dominance is shifting the responsiveness of the markets.
Yes, he suggests that traditional market support will wane as fiscal policies increasingly dictate outcomes.
Hold on. So we're saying policies that once supported markets are now making them shaky?
That's right. It's a major pivot point. Then there's Jeff Snider, who dives into the manufacturing sector's downturn.
Yes, he details how this meltdown is crucial for understanding broader economic fundamentals.
So fewer goods being made means a struggling economy.
Exactly. That connection is critical. And finally, Nick Gerli points out that the real estate market is winding down from its sugar high.
Right, he forecasts significant corrections as the exuberance fades.
So my house isn't going to be worth as much anymore, huh?
If he's right, that could definitely be the case. Let's look at their overlapping views. Across the board, all the guests agree the current economic environment is quite unstable.
Yes, they each emphasize different aspects but recognize the need for vigilance.
So basically, it's a hot mess out there.
In simpler terms, yes, stay alert. Cem, Jeff, and Rick all emphasize how commodity prices influence their economic outlooks.
Correct. They see rising resource prices as a crucial element for shaping economic trajectories.
So if metals and resources go up, that changes everything for them.
Exactly. That's the thread tying their arguments together. Additionally, Eric and Nick find common ground about the implications of real estate trends.
Yes, both see housing dynamics as pivotal for economic health.
So what's happening in real estate is more than just home values. It's about the whole economy.
Exactly. It's all interlinked. Here's where it gets interesting. Eric thinks we'll see dominoes fall in under 2 years.
Nick, on the other hand, argues recovery will take much longer, potentially 3 to 5 years.
Wait, so we're looking at different timelines? That's a massive gap.
Absolutely. And that gap can significantly impact investment decisions. Cem argues that fiscal dominance is now more crucial than monetary policies.
But Jeff counters that the health of the manufacturing sector is essential for understanding economic responses.
So one thinks fiscal rules the roost, while the other says it's all about manufacturing.
Exactly. It's a fundamental philosophical difference. Now on the investment front, Rick believes it's time to pour money into resources.
In contrast, Jeff warns against overvaluation in that space, reflecting a stark difference of opinion.
So Rick is ready to dive in while Jeff says not so fast.
Correct. One sees opportunity, the other sees caution. Thanks for sticking with us through this insightful breakdown. If you found it valuable, make sure to hit that like button.
And don't forget to subscribe for more concise expert analyses delivered right to you.
I know I learned a ton today, and I bet you did too.
Join us next time for even more perspectives. See you soon.